Stephen Nash joins us from FIIG Securities in Sydney. Stephen, how important are these retail sales numbers for the RBA decision, and maybe even the timing of the next cut or the size of the next cut?
Yeah, look, I think retail sales are one of the important indicators. I think the RBA is concerned about the consumer being conservative and the saving rate being quite elevated right now. I think any weaker than expected number, markets are going for a small increase, will get bonds rallying quite substantially. We're very close here to 3% on the 10-year bond, so a weaker number could push us right through that 3% level. It's almost, it's an unheard of level in terms of Australian bonds, particularly the 10-year area.
Yeah, for sure. I've just seen flash up the last few moments as well, Stephen, a 2027 bond going to tender, so 2027 bonds yielding 3.4844%. All of these figures, you kind of scratch your head about, why we're seeing such low yields, or does it make complete sense?
Well, it does in a sense that what the bond market's doing is looking at lower growth for longer, and I think that message has finally got through to equities, and we've seen equities coming off. But I think it's also causing a lot of fear among a lot of self-funded retirees at the moment with exposure to term deposits, and they're relying on these term deposits with the prospect of further rate cuts. The question is, what do they do now as their income shrinks? I think one of the suggestions may be to look at fixed income, but I think there's a lot better yield there, but I think there's a lot of education that has to go with that. And we're seeing a lot of issues out. We've seen the TATS issue and a few others coming out of late. It seems to be where the demand is right now. People want debt and not equity.
What about, I'm just thinking if rates start to fall from here, because I guess some people are still even pricing in quite significant rate cuts. How does that affect kind of the investment options for people in the space?
Well, we're going to see lower and lower term deposit yields, and people will be effectively forced out of term deposits into something that yields a little bit more. Something around 6% or more in the fixed income space looks now pretty attractive. If we get that lower growth for longer, those investments will perform very well and also give a lot less volatility than equities do at this stage.
Yeah, on the Australian dollar, Stephen, you kind of mentioned a couple of thoughts around how it could trade with the retail sales numbers.
Yeah.
There's a point though, we're at 98 US cents at the moment, which is down even from 108, a couple of months ago from February.
Yeah.
So it's moving. It looks like it's moving that direction, and we've seen quite a big move already. At what point does that start to reduce the chance of another rate cut?
Look, there are some already. There's some impacts from a lower Australian dollar in terms of inflation. I think they're quite minor right now, and the RBA is focusing on what's going on in the non-mining sector, which, as we know, is fairly recessed. I think as we approach, or if we approach closer to the 90-cent level, that will start to raise a few more eyebrows in the RBA, and I imagine that there may be some concern about the effect on inflation from that lower currency. So we are a fair way away from that right now, but a lower retail sales figure may get that currency moving a little bit lower.
Stephen, just before we finish off with you, anything else that people are really buzzing about there this morning in your office?
Oh, look, we're looking at what's going on in the Spanish banking system. There seems to be a bit of a disconnect between the Spanish authorities and the ECB. One would have expected more cooperation between those two bodies, and I think going forward there has to be more cooperation, and I imagine the ECB will be crucial in terms of assisting those Spanish banks in terms of cash flows, and particularly any withdrawal of deposit at this stage.
How do they assist them? Because the government in Spain, as we were reporting, came up with a bit of a nifty plan, which the ECB said, absolutely not. It was a ridiculous bailout idea or recapitalisation idea for some of these Spanish banks. I sit here every day still struggling to decide what the next step is, what can actually help.
The ECB has been supporting most of the European banking system for about 4 years now, so they're very experienced in terms of assisting banks as they have liquidity problems. So the provision of liquidity to banks that have runs on deposits, I think that can be expected going forward. There's got to be more cooperation within Europe, and I think the Germans are slowly coming to that realisation that there will be a large fallout in terms of their economy if they don't cooperate in assisting the European banking system overall.
Fantastic, Stephen. Thank you very much.
Okay.
We will chat soon. That is Stephen Nash from FIIG